Imagine having millions of dollars in guaranteed revenue sitting right there on the table in front of you.
Just ripe for the taking.
Right. And your competitors are absolutely scrambling for it. They're undercutting each other, desperate to scoop it up to pad their quarterly earnings.
Oh yeah, a total race to the bottom.
Exactly. And you just look at it, run the math in your head, shake your head, and just walk away.
It's wild to think about, but that is exactly what we are seeing today.
Yeah, American International Group intentionally shed 9 percentage points of premium retention in their Lexington property book this quarter.
9 points.
Yeah, they literally watched millions walk out the door and let the competition have it.
Which is just a staggering strategic decision, honestly.
Right, because most management teams are terrified of the optics of a shrinking top line.
Oh, absolutely. It requires an immense amount of institutional discipline to voluntarily shrink a major revenue stream. But doing so to protect your balance sheet from mispriced risk. That's the hallmark of a really mature underwriting culture.
Well, welcome to a very special, extended, deep dive edition of the Talk Tickers format.
Yeah, normally we promise you a rapid-fire rundown, but today is different.
Right, usually we hit the 3 or 4 main takeaways in under 5 minutes. But today's subject, AIG's Q2 2026 earnings call. It's just so packed with massive strategic shifts and complex macro crosscurrents.
It's incredibly dense Wall Street data.
Exactly. So it demands a full, exhaustive breakdown. But our mission remains the exact same for you, the listener. We are going to be data forward.
We'll translate the jargon into plain language.
We'll take an opinionated stance on management performance.
And most importantly, deliver actionable insights for anyone holding or even just considering AIG stock.
So here is the roadmap for today. We're breaking this down into 4 parts. First, the headline numbers. Second, the story behind the numbers. Third, management guidance.
And fourth, the Talk Ticker's bottom line.
Let's jump right in. If you are joining us to get a read on the macroeconomic weather, you are definitely in the right place. An insurer's balance sheet is basically a mirror reflecting the global economy.
Yeah. By tearing open AIG's call today, we're going to understand the current state of global shipping.
Massive bottleneck in AI infrastructure.
The terrifying rise in corporate litigation.
And the influx of shadow capital and real estate. There are just a massive volume of strategic shifts happening under the hood right now.
It's fascinating. I mean, we are looking at a global property and casualty giant entirely re-engineering its growth engine. And they're doing it while navigating some of the most complex geopolitical stuff we've seen in years.
Okay, want to hit you with the core top-line data drop right out of the gate. On the surface, these Q2 numbers are heavy hitters.
Oh, very much so.
Adjusted after-tax income per share, their EPS hit $2 flat.
Which is a really solid 10% year-over-year increase.
Right, and total adjusted after-tax income was $1.1 billion for the quarter.
I think contextualizing that $1.1 billion is vital here.
How so?
Well, management openly described the current environment as transitioning. They're moving away from a phase of broad, easy, positive pricing into a much more selective, hyper-competitive market.
So maintaining a 10% EPS bump when the tide is no longer just lifting all boats, that's a major signal of baseline stability.
Exactly. They are proving they can swim against a current.
Their core operating return on equity tracked at 11.1% for Q2. And it actually held at 11.6% for the entire first half of 2026.
Really strong numbers.
Yeah, and underwriting income rose 10% to $686 million. Plus, total net premiums written increased by 9%.
But the detail that really jumps off the page is what happens when you exclude North American property.
Right. If you strip out that specific segment, net premiums written actually increased by an impressive 11%.
And that 11% figure, that's the skeleton key to this entire quarter, I think.
Because it shows they still have a growth engine.
Exactly. It immediately flags that AIG possesses this massive, aggressive engine of growth. But it's being intentionally masked by that very specific anchor in North American property that we mentioned earlier.
Right, the whole walking away from millions thing.
Yeah. And to understand the friction there, we have to look at the core metric that basically dictates any insurer's survival.
You mean the combined ratio?
Yes, the combined ratio.
Every time we cover an insurance firm on this show, the executives treat this number like the Holy Grail.
Because it is. For anyone who, isn't spending their weekends reading actuarial tables, you really need to understand the implications of this metric.
So break it down for us. It's simply the sum of the money an insurer pays out in claims plus their operating expenses.
Right. And then you divide that by the premiums they collect. So a combined ratio under 100% means the company is turning a pure underwriting profit.
Okay, so if they take in $1 and spend 90 cents on claims and salaries, their combined ratio is 90%.
Exactly. They made a dime before even touching their investment portfolio.
Which is huge. So looking at AIG's Q2 2026, their general insurance accident year combined ratio as adjusted improved by 30 basis points to 88.1%.
88.1%. That means they are keeping almost 12 cents of every single premium dollar as pure operational profit.
And that 30 basis point improvement, 0.3%, it might sound like a rounding error to a casual observer.
It does, but in this specific macroeconomic environment, squeezing out another 30 basis points of margin is practically lethal to competitors who are struggling just to break even.
It's a massive testament to their underwriting discipline. Furthermore, their calendar year combined ratio was 89%, which is also a 30 basis point improvement over the prior year.
And, the distinction between those two ratios is critical for gauging the health of the book.
Right, the accident year versus the calendar year.
Yeah. The accident year metric isolates the premiums and losses that actually occurred in this specific 12-month period. It ignores the ghosts of the past, basically.
It tells you how good their underwriters were this year specifically.
Exactly. Whereas the calendar year includes all the adjustments and baggage from claims that happened years ago but are being settled now.
Right. And the fact that both of these metrics are sitting comfortably in the high 80s just proves the core underwriting engine is humming along.
Oh, without a doubt.
But, an insurance conglomerate is really just a massive hedge fund bolted onto a risk assessment business, right?
Basically, yeah. They collect billions in premiums up front and invest that cash until the claims come due.
So how are they managing that float? Because general insurance net investment income was completely flat year over year. It sat at $871 million.
Now, flat implies a lack of movement, but underneath that $871 million, there is this violent tug of war taking place between different asset classes.
What do you mean?
You cannot look at a flat net investment income figure in an environment with shifting interest rates and assume it's just the status quo.
Okay, so let's dig into that. The fixed income portfolio, the bonds, the traditionally safe yield actually grew by 4%.
Right. And because we are in a higher rate environment, AIG's new money yields were 60 basis points higher than the assets rolling off their books.
Oh, wow. So they were pulling down an annualized yield of 4.72% on new fixed income.
Exactly. They are taking bonds that matured at 2% or 3%, taking that cash, and buying new paper yielding almost 5%.
That should be sending their investment income through the roof. Why is the total number completely stagnant?
Well, the anchor dragging down that massive fixed income victory is their alternatives portfolio, specifically private equity. Yeah, AIG reported a brutal quarter in alternatives, highlighted by an $8 million loss in private equity alone.
Which feels entirely disconnected from the broader equity markets in Q2, doesn't it? Like, why are they taking private equity losses when the public markets were relatively stable?
It basically comes down to the mechanics of lagged reporting.
Okay, explain that.
Private equity isn't like a publicly traded blue chip stock where you can just check the price on your phone at 4:00 p.m. These are illiquid, highly complex investments in private companies. So AIG operates its private equity reporting on a 1-quarter lag. That $8 million loss reported in Q2 is actually the financial scar tissue from market volatility and valuation markdowns that happened back in the first quarter of 2026.
Ah, got it. So they were essentially paying the price today for a rocky Q1 in the private markets.
Exactly. But even with that substantial drag from alternatives, the fixed income yield is generating just a river of cash.
And you can see the confidence in how they are choosing to return that capital, right?
Oh, absolutely.
In Q2 alone, they aggressively returned $904 million to shareholders.
That's almost $1 billion in a single quarter.
Right. And that breaks down to $263 million in dividends and a massive $641 million in share repurchases.
And look, deploying $641 million into buybacks in a single 3-month window, that is management screaming from the rooftops that their equity is deeply undervalued.
I mean, when a board with access to this much sophisticated financial modeling decides the single greatest return on capital is their own stock, you need to pay close attention.
Right. It creates a structural floor under the valuation.
Okay, so the headline metrics paint a picture of undeniable strength. The combined ratios are phenomenal, EPS is up, and they are buying back stock hand over fist.
But
top-line aggregates are dangerous if you don't look at how they are manufactured. To know if this profitability is a durable trend or just a momentary fluke of favorable weather and accounting gymnastics, we have to dissect the specific lines of business.
Exactly. We need to look at where the friction is the most intense right now.
So let's talk about the story behind the numbers. Where is that epicenter of friction for AIG?
It is undeniably the North American property market, particularly within their excess and surplus lines, or E&S.
This is the Lexington portfolio, right?
Yes, and management's commentary here paints a picture of a market that has become structurally chaotic.
So if you aren't familiar with E&S, think of it as the safety valve of the commercial insurance world. It is the market of last resort.
Right, like if you own a massive coastal resort in a hurricane zone.
Or a highly combustible chemical manufacturing plant. Yeah.
Mm-hmm.
Standard regulated insurers will likely refuse to underwrite you. You are forced into the E&S market.
And historically, operating in the E&S property space granted you immense pricing power.
Because the clients had no other options.
Exactly. You were taking on localized, severe risks, but you could charge exorbitant premiums. But the market dynamics have shifted violently over the last few quarters. AIG is facing a massive, unprecedented influx of shadow capacity flooding into the E&S space.
Management specifically called out MGA's managing general agents, as well as ILS, which are insurance-linked securities and sidecar vehicles.
For anyone holding insurance stocks, these are the disruptors you absolutely need to track.
So what exactly is this alternative capital doing to the ecosystem?
Well, outside capital, we're talking hedge funds, massive pension funds, sovereign wealth. They looked at these staggering profit margins E&S property generated over the last few years, and they wanted a piece of the action.
Sure, everybody wants high yields.
Right, but they don't want to build an entire insurance company from scratch. So they pour billions into ILS structures or give underwriting authority to these MGAs.
And these MGOs are essentially highly specialized underwriting boutiques, right?
Right. They do not carry the catastrophic risk on their own balance sheet. They underwrite on behalf of this alternative capital.
So you have a tsunami of new, hungry money rushing into the casino, willing to take on massive hurricane and wildfire risks.
And the basic laws of supply and demand take over. When capacity floods a market, everyone starts slashing prices to win the business.
Which explains why AIG's management noted intense, irrational competitive pricing pressure.
Yes. The rates currently being offered by these new entrants simply do not adequately cover the statistical reality of a major catastrophe.
Which brings us back to the 9 percentage point drop in Lexington's retention.
AIG basically refused to engage in a race to the bottom.
They're watching competitors underprice catastrophe risk. And they are intentionally shrinking their exposure rather than putting their balance sheet in jeopardy for a few basis points of market share.
Exactly.
Okay, shrinking the property book stops the bleeding from bad pricing. I get the defensive logic, it is disciplined.
Yeah.
But you cannot shrink your way to long-term profitability.
Yeah.
Wall Street demands growth. If they are aggressively amputating 9 points of retention in Lexington, where is the tourniquet? And more importantly, where's the new blood coming from?
You have to look at the other side of the North American portfolio. The capital they are pulling out of volatile property lines isn't just sitting in a checking account gathering dust. No, it is being violently redeployed into casualty.
Okay, this is where I have to push back hard. The pivot to casualty seems wildly counterintuitive given the current environment.
How so?
Well, we have covered the existential threat of social inflation on this show before. We are seeing nuclear verdicts from juries, $50 million, $100 million in damages and liability cases.
Oh, absolutely. The litigation environment is brutal.
We have third-party litigation funding where private equity firms are literally financing lawsuits as an alternative asset class. The liability environment is toxic. Why on earth would AIG run into the propeller blades of North American casualty?
Because of pricing power and structural control.
Okay, explain.
The pricing dynamics in casualty right now are the exact inverse of the property market. In North America retail casualty, AIG reported pricing is up 10%.
Wow.
And in excess casualty, which are the policies that kick in after primary limits are blown through by those nuclear verdicts, pricing surged by an unbelievable 14% in a single quarter.
A 14% rate hike is massive.
Yeah.
But does a 14% hike actually cover the risk if juries are handing out unprecedented awards?
Management explicitly stated that these rate increases are exceeding loss cost trends, meaning the price they are charging is accelerating faster than the cost of the underlying claims they are forecasting.
Okay, that's reassuring.
And more importantly, when an analyst asked if AIG was seeing any signs of social inflation or litigation funding moderating in the U.S., Management was incredibly blunt.
What did they say?
They see absolutely zero signs of moderation.
So they are looking at a raging fire and choosing to insure the buildings next door.
Yes. But they are demanding exorbitant premiums and dictating the terms. They specifically mention tightening attachment points.
Now, for your portfolio, understanding attachment points is critical. It means AIG is forcing the corporate client to absorb significantly more of the initial loss out of pocket before AIG's coverage even activates.
It is a ruthless, highly sophisticated play. They are offering lower overall limits, forcing higher attachment points, and charging 14% more for the privilege.
So they're baking the worst-case social inflation scenarios directly into the premium.
Right. If you underwrite it with absolute precision, that environment becomes a cash machine because corporate clients are terrified of the liability landscape and they simply must buy the coverage at whatever price AIG dictates.
Wow. So this mix shift, deliberately walking away from underpriced catastrophe property and leaning heavily into hyperpriced casualty that defines their domestic strategy.
Yeah, but AIG is a global behemoth. The international numbers present a jarring contrast to what we are seeing in the United States.
Let's look at those international numbers, because the divergence really is stark. While the U.S. casualty market is hardening aggressively, the international commercial renewal pricing actually declined by 6%.
Right, and the energy sector dropped a whopping 15%.
Financial lines were down 4%.
Yeah.
So if the U.S. market is so hostile with litigation, why are prices dropping everywhere else?
Management noted that this international decline comes after multiple consecutive years of compounded rate increases.
So they already had their run-up.
Exactly. The international market essentially peaked, capital rushed in to capture those high rates, and now the cycle is softening. Competitors are fighting for market share, which drives prices down. Management specifically called out global specialty and energy, stating they are watching those markets like a hawk because current pricing does not reflect heightened real-world exposures.
And you cannot talk about heightened international exposure without talking about geopolitics.
Definitely not.
Real-world conflict has an immediate, tangible impact on an insurer's balance sheet. AIG actually took $75 million in net catastrophe losses related strictly to the Middle East conflict in Q2.
And we are primarily looking at marine and shipping impacts near the Strait of Hormuz and the Red Sea.
Right. These are the most critical choke points for global supply chains.
When geopolitical conflict erupts, the risk of commercial vessels being attacked, seized, or massively delayed skyrockets. And AIG is writing the marine insurance for those hulls, as well as the business interruption coverage for the cargo.
So that $75 million loss is the direct financial manifestation of global instability.
Yes, it is. But here is the fascinating twist. Because of that exact instability, corporate clients are terrified. They are desperate for coverage.
And AIG utilized that fear to radically shift pricing in another division, right? Political violence and terrorism coverage.
Exactly. In the first quarter, pricing for political violence actually dropped by 8%. But in Q2, as the Middle East conflict escalated, AIG reversed that entirely, hiking pricing by 9%.
That's a 17-point swing in pricing strategy in just 90 days.
It really illustrates the sheer agility required to manage a global book. They absorb a hit in marine lines, but immediately utilize the heightened risk environment to expand margins in political violence.
Okay, so while the commercial and international lines are wrestling with macro complexity and war, there's one segment of AIG that management highlighted as an absolute gold mine this quarter.
Oh, global personal insurance.
Yes. It is the hidden gem of the entire transcript.
This segment is driven predominantly by accident and health A&H and high net worth businesses. They drove an 8% increase in net premiums.
But top-line growth is only half the story here. The profitability metrics are just staggering.
Tell me about it. The accident year underwriting income for this segment more than doubled.
Doubled. And the accident year combined ratio plummeted by 490 basis points, landing at an incredibly profitable 91.2%.
Look, dropping a combined ratio by nearly 5 full percentage points in a mature business line is almost unheard of.
Right. So what is the structural advantage they have here? Why is it suddenly so profitable?
It's a combination of ruthless underwriting actions and the inherent nature of the high net worth demographic.
Right, insuring multi-million-dollar estates and luxury auto fleets.
Exactly. The personal liability of ultra-wealthy individuals is a fundamentally different business than standard personal auto or home insurance. The asset values are massive, and the clients are significantly less price sensitive to premium hikes as long as the service is bespoke.
And what about on the accident and health side?
Well, A&H is characterized by high transaction volume, but much lower individual claim limits. It relies heavily on statistical, actuarial predictability rather than catastrophic risk assessment.
So they don't have to worry about a single event blowing up the entire quarter.
Exactly. When you refine your data models and get the math right on A&H, it transforms into an incredibly consistent, high-margin cash generator, and they clearly recalibrated those models successfully.
Speaking of getting the math right, we have to look under the hood at the single most complex and arguably most important accounting exercise an insurance company performs.
Reserves.
Reserves. For anyone investing in this space, you have to understand that an insurance company doesn't actually know its true cost of goods sold for years, sometimes decades, after it sells a policy.
It really is the ultimate test of an insurer's integrity. When AIG collects premium today for a liability policy, they have to estimate or reserve a massive pot of money to pay for claims that might not be filed, litigated, or settled until 2030.
Right. And prior year reserve development is how we grade their past math.
Yeah, when they look back at the reserves they set aside in 2018 or 2021, were they overly optimistic or were they conservative?
Well, in Q2, AIG released $145 million in favorable prior year development.
And favorable development is exactly what you want to see.
Because it means they looked at past years, realized the claims environment wasn't as bad as they modeled, and they get to take $145 million of that reserved cash and dropped it straight to the bottom line as pure profit.
Precisely. The primary driver of that windfall was a $177 million release in U.S. workers' compensation.
Workers' comp has been a highly reliable, profitable line for the industry as workplace safety technology improves and claim frequency consistently drops.
Yeah, absolutely. But the reserving picture wasn't entirely favorable across the board, and this is where we see management's true risk appetite.
They actually strengthened U.S. excess casualty reserves by $74 million, specifically calling out accident years 2016 and 2023.
Which means they had to pull $74 million out of current earnings and lock it away in the vaults to cover past policies.
But wait, if 2023 was just last year, why are the claims suddenly blowing up?
That is the exact question analysts pressed them on during the call, and the answer is crucial for your understanding of their defensive posture.
What do they say?
Management explicitly stated they are not seeing material deterioration in 2023. They aren't seeing a sudden spike in frequency or severity of claims for that year.
Then why take the $74 million hit to earnings now?
Because of prudence. They are looking at the toxic social inflation and nuclear verdicts we discussed earlier. They have implemented incredibly strict conservative limit management strategies for 2024 and 2025.
Okay.
So they decided to proactively strengthen 2023 just to align it with the defensive posture they are taking today. They are essentially pre-funding the potential future nightmare of social inflation out of current quarterly strength.
Oh, wow. They are essentially saying the claims haven't hit us yet, but we know the legal environment is a minefield, so we are going to stash more cash away for 2023 right now, just in case.
Exactly. This level of proactive granular reserve strengthening is a massive green flag for long-term holders.
It proves management is not playing accounting games to artificially inflate current earnings. They are building a fortress balance sheet.
It is a masterclass in dynamic portfolio optimization. I mean, they are walking away from volatile property, leveraging immense pricing power in U.S. casualty, capitalizing on geopolitical fear, printing cash and high net worth, and defensively fortifying their reserve.
But, strategy is useless without operational execution.
Very true.
How does management plan to actually run this machine over the next 24 months? Which brings us to part 3. Management guidance and strategic operations.
And their biggest, most aggressive operational target right now, expense discipline.
Right. Management is laser focused on driving the general insurance expense ratio below 30% for the full year 2027.
Look, an expense ratio below 30% is the holy grail for a legacy multinational behemoth like AIG.
For context, they ended 2025 at 31.1%.
And the current rolling 4-quarter average is sitting at 30.7%. So they are grinding this metric down 0.1% by 0.1%.
But how do you actually achieve that in an environment plagued by persistent wage inflation and rising operational costs? So you can't just keep laying off middle management or turning down the thermostat in the New York headquarters.
The primary mechanical driver they are relying on is called premium leverage.
Premium leverage, okay.
Remember that 13% net premium written growth they achieved in the first half of 2026.
Ah, right. The underlying growth engine that was masking the property pullback.
Precisely. Written premium does not instantly become earned premium on the income statement. It earns in gradually over the life of the policy, which is usually 12 months.
Okay, I follow.
So that massive wave of premium growth from the first half of 26 is going to steadily flow through the books over the remainder of 2026 and into 2027.
And if AIG can just hold their fixed operational expenses relatively flat, which they successfully achieved in the first half of this year when adjusted for foreign exchange fluctuations, the growing premium base naturally dilutes the expense ratio.
Exactly. The denominator expands, so the ratio shrinks.
Elegant, undeniable math. But there is a secondary operational lever here, and this is the detail in the transcript that fundamentally changes how this company operates.
Yeah, the tech integration.
Right. I always ask how these legacy firms modernize their workflow without just aggressively cutting headcount, and AIG's answer is deeply integrated technology. Let's look at the rollout of AIG Assist.
This is where the archaic world of commercial insurance collides with the cutting edge of artificial intelligence. AIG has deployed internal AI platforms dubbed underwriting by AIG Assist and claims by AIG Assist.
And the surface-level corporate messaging is pretty predictable, right? It increases speed and productivity.
Yeah, underwriters can ingest hundreds of pages of submission documents instantly, generate quotes faster, and claims adjusters can process payouts with less friction.
So AI makes you read documents faster. We've heard that pitch from literally every Fortune 500 company this year.
We have? But the true application of AIG Assist is far more predatory and brilliant. It is not just about workflow speed. It is about data mining their entire global distribution ecosystem. Management revealed that as every single submission flows through the Assist platform, they are using the AI to track and grade performance at the individual broker level.
Wow. It completely alters the balance of power. AIG now possesses granular visibility into exactly which broker offices, and potentially down to the individual broker, are consistently sending them highly profitable, well-structured business.
And which ones are flooding the system with garbage submissions that waste underwriters' time and drag down margins?
It's exactly like a high-end casino. For decades, the casino relied on promoters to bring gamblers through the doors. In the past, the casino manager only knew that promoter A brought in 100 people total.
Right.
But now, AIG Assist is essentially putting facial recognition cameras and RFID chips on every single gambler. Suddenly, the casino knows that promoter A brings in 100 people, but they all play the penny slots, drink the free well liquor, and lose the casino money on overhead. But promoter B only brings in 10 people. And they are all high rollers who sit at the baccarat table and generate massive, predictable margins for the house.
That is a perfect analogy. AIG is utilizing this AI-driven broker insight to ruthlessly optimize their distribution pipeline. Once they identify the statistical high-yield partners, they redirect their best underwriting resources, their top relationship managers, and their dedicated capacity directly to those offices.
So they actively stop wasting operational cycles on the penny slot brokers.
Exactly. And this allows them to scale their premium intake dramatically without scaling their headcount, which directly fuels that drive toward a sub 30% expense ratio.
It is a profound structural shift away from the traditional relationship-based underwriting model toward a ruthless, data-driven optimization of distribution.
And it perfectly complements their broader strategic deployments and capital allocation.
Right, we need to look at the mega risks they are taking on, starting with geographic expansion. They announced an agreement to acquire Everest Insurance operations in Colombia. Why target Colombia while shrinking property in the U.S.?
Well, Latin America represents one of the fastest developing commercial insurance markets globally. It provides critical geographic diversification,
insulating them slightly from the hyper-litigious U.S. casualty market and the saturated U.S. property market?
Exactly. It grants AIG a firm foothold in an emerging commercial sector where baseline insurance penetration is historically lower, so there is a much longer runway for organic growth.
A classic frontier growth play. But if Colombia is the geographic frontier, the technological frontier definitely lies in data centers. Management spent a significant portion of the call highlighting their unique, dominant positioning in ensuring global AI hyperscaler data centers.
When you conceptualize an AI data center, the aggregation of risk is almost incomprehensible. You are not just insuring a large warehouse.
Oh.
You are looking at multi-billion-dollar, multi-year construction projects packed with the most expensive, heat-generating, power-hungry GPU clusters ever manufactured.
And to underwrite one of these hyperscaler projects, you have to provide coverage for the initial complex financing, the physical construction phase, the highly perilous marine transit of the servers across the Pacific.
Not to mention the massive cyber liability of the data itself and the ongoing operational risks involving massive cooling systems and power grids.
It's massive. Very few insurers on the planet possess the balance sheet scale, the multi-line technical expertise, and the sheer risk appetite to bundle all of those disparate policies together into a single, cohesive master program for a tech giant.
Right, and AIG is aggressively signaling to the market that they are the premier underwriter capable of facilitating the AI infrastructure boom.
Which requires an incredibly pristine, bulletproof balance sheet to pull off. Which brings us to capital management and a massive historical milestone for AIG. The CFO noted that their debt-to-capital ratio sits at a highly conservative 17.6%.
But the true headline event is the final exit from Corebridge.
Yes. In May, AIG sold its remaining 25 million shares of Corebridge common stock, generating $710 million in cash.
For anyone who hasn't closely followed the decade-long corporate saga of AIG, this is huge.
Why is severing ties with Corebridge such a monumental event?
Corebridge represents AIG's former life and retirement business. For 5 grueling years, AIG management has been executing a highly complex, painful process of separating that massive business, spinning it off into the public markets, and systematically selling down its retained stake.
So by liquidating this final tranche, they have officially closed the book on a 5-year corporate divorce.
Yes. They are now unequivocally a pure-play global property and casualty insurer.
No more highly sensitive life insurance mortality models dragging on the capital framework. No more complex retirement annuities mixing with commercial property risk. It simplifies the investment thesis entirely.
And they walked away from that final transaction with another $710 million injected into an already massive cash hoard.
We have assembled all the pieces. We have the robust underlying profitability, the aggressive portfolio trimming in property, the massive rate hikes in casualty, the AI distribution optimization, and a balance sheet flush with excess capital.
It's a very complete picture.
So what does this all mean for your portfolio? We have gone deep into the actuarial weeds. Now we need to pull it back up and deliver the actionable takeaways. This is part 4, the bottom line. Where do you stand on AIG's Q2 2026?
My definitive position on this quarter is that the transcript is a highly bullish signal for long-term investors seeking quality, balance sheet stability, and margin expansion. But it serves as a stark cautionary tale for momentum investors who are blindly expecting aggressive, double-digit top-line revenue growth across the board. Management could not have been clearer. They explicitly stated they will not chase growth blindly.
They're actively shrinking parts of the business to protect the bottom line. So if you are just looking at top-line revenue charts on a screener, AIG might look stagnant or confusing.
Exactly. But if you look at the fundamental value, it is a completely different narrative. Let's translate this into a direct strategy. First up, the valuation play.
Okay, let's look at the book value. Book value per share is up to $77.39.
And more importantly, adjusted tangible book value, which strips out all the intangible assets like goodwill to give you the hard liquidation value of the actual assets the company holds, is sitting at $72.18.
Management themselves stated on the call that the stock is currently trading at a modest premium to tangible book value.
And that phrasing unlocks their entire capital management strategy. For a company generating this much free cash flow and operating with combined ratios in the high 80s, trading right around its tangible book value is an incredibly attractive, historically cheap entry point.
Which brings us to the second actionable takeaway, the buyback floor. Because of this depressed valuation, management views their own stock as the single best investment available on the market.
We saw the undeniable proof, $641 million deployed into share repurchases in a single 90-day window.
For you as a retail investor, aggressive and persistent share buybacks at these valuation levels create a massive structural floor under the stock price.
Yeah. If AIG's management looks out at the macro environment and cannot find highly accretive inorganic acquisitions, or if the property lines remain flooded with cheap alternative capital so they can't deploy cash there, they are going to continuously utilize that excess capital to buy back their own shares.
Which artificially reduces the outstanding share count, which mathematically drives up your earnings per share, even if core net income remains completely flat.
It is the ultimate defensive growth mechanism.
But no investment thesis is bulletproof. We have to address the risk. What is the primary metric you need to monitor over the next few quarters that could unravel this?
The main risk metric to watch is the core loss ratio creeping up. And the reason it will likely creep up is entirely due to the strategic mix shift we discussed earlier.
You mean the pivot away from E&S property and into U.S. casualty?
Exactly. Property insurance, specifically during a light catastrophe quarter when hurricanes don't make landfall, generates staggering profit margins. It operates with a very low baseline core loss ratio.
Yeah.
Casualty insurance, on the other hand, inherently runs at a higher baseline loss ratio because claims are constantly being litigated and paid out over a longer time horizon.
So as AIG intentionally amputates its high-margin, highly volatile property business and simultaneously balloons its higher loss but highly stable casualty business, the aggregate blended core loss ratio of the entire corporation will naturally tick up.
It is unavoidable mathematical gravity. The risk here is that algorithmic trading bots or superficial analysts see the loss ratio rising and blindly hit the panic button, triggering an unwarranted sell-off.
But the actionable insight for your portfolio is this. Do not panic over a creeping core loss ratio, provided the overall combined ratio stays firmly anchored in that 88% to 89% range.
Right. As long as the combined ratio holds stable, the mix shift is working exactly as management intended. They are successfully trading unpredictable volatility for long-term consistency.
That is incredibly clear. Bullish on the capital management, buyback floor, and structural pivot. Cautious on top-line growth expectations, and keep a very close eye on the combined ratio to ensure the massive bet on casualty is actually paying off.
We promised an exhaustive breakdown, and I think we have illuminated every corner of that balance sheet.
I think so too. But before we wrap up this deep dive, I want to leave you with a larger, almost existential industry question sparked by what we uncovered today.
Oh, I know exactly which operational detail you were going to highlight.
You do, because it is the most disruptive concept buried in this dense sea of actuarial numbers. Building on that revelation about AIG Assist, the fact that they are actively utilizing artificial intelligence to track and grade individual broker performance based on the statistical profitability of their submissions, it raises a massive question for the entire financial ecosystem.
It has profound sociological implications for how risk is traded.
Yeah. As AIG, and inevitably every other mega insurer on Wall Street, trains their AI models to identify exactly which human brokers bring in the most profitable, low-risk clients, are we witnessing the beginning of the end for the traditional relationship-based insurance broker?
It's entirely possible.
Think about the history of this industry. For a century, commercial insurance distribution was built on golf games, steak dinners, handshakes, and personal trust. But if a black box algorithm decides your submissions are statistically subpar, will middle-tier brokers simply be blacklisted by the AI gatekeepers?
Yeah, if the computer calculates that your clients lose the casino money, do you even get let in the door anymore?
It suggests a near future where multi-million-dollar underwriting capacity is only granted to statistically optimized distributors.
Yeah.
The human element, the relationship capital, becomes entirely subservient to the AI's risk-adjusted return model.
It brings us right back to where we started. We are watching a legacy industry shed its old skin.
They aren't just walking away from bad property deals. They are building an AI machine that doesn't just evaluate the risk. It ruthlessly grades the human being who brought them the risk. Thank you for taking this extended deep dive with us today. You are now perfectly positioned to understand AIG's next moves, the macroeconomic forces driving their balance sheet, and the algorithmic future of risk itself.